Hello, everyone. Welcome to Now Next Later for Monday, December 16th. We're excited to have David Battany with us today. We'll get to David in just one second, but Sasha, how are you?
I'm doing well. How are you, Jer?
Excellent. Thank you. David, we like to jump right in, but I'll say one thing. When I was first introduced to you, now we're going back, 10 or 15 years, but when I was first introduced to you, a really good friend of mine said David Battany has the highest approval rating in mortgage. And that has remained true from that day to this one. So you have a lot of fans out there, and we're really excited to talk Now Next later. So thanks for joining us.
I need to make sure I keep my payments up to that person who ever said those kind of things. So that's a wonderful way to start my Monday. Thank you.
Right on. Well, we'll jump right in. We do, as I had emailed you, we do now, next, later. And on the now part, you are EVP of Capital Markets at Guild Mortgage. You also are very involved in the industry, having come from the GSE world, working very closely with MBA and on these critical issues that the industry faces. So I thought maybe what we would start with is that balance that you have to strike between what we're working on, keeping the business moving forward, winning the market share battle and the innovation battle for Gil, but then also being thoughtful about where we're going and how we work together as an industry while we compete with each other. So just out of curiosity, for 2024, Guild grew through acquisition. So you're juggling all kinds of things. I was curious if you could just talk us through what your role in the capital markets with product development, roadmaps, resources, what that looks like in the mortgage industry in 2024.
Sure. Yeah, it's been a very exciting year with the growth and just all the activity in the industry. I think the challenges we face are really an affordability challenge. For basically, as an industry, we were overproducing homes leading up to 2008. We were actually building more units of housing than we had households. But because home prices were rising so rapidly, there was no correction to that imbalance. And it wasn't until really, the crisis hit. And if you recall back on news headlines in 2008, I mean, people were saying, political leaders were saying, we should take these newly built subdivisions and bulldoze them down just to remove supply from the market. So we had incredible oversupply that was one of the contributors to 2008's crisis. And then really, builders and builder trades were just devastated. As much as it was tough for the housing industry, it was really tough to be in the building industry in that time. So a lot of those firms, went bankrupt and those people never came back. It wasn't just like a temporary slowdown. It was like they were done. So as a country, we stopped building. We had a lot of oversupply from like '09 through, early 2010, 2011. And at some point, we sort of hit our equilibrium as the population of households grew. And then where we are today, where we're short probably 4 million units. So that's the biggest challenge we face. It's a challenge the Guild faces. It's a challenge the whole industry faces. So that lack of supply is one of the fundamental challenges. It's taken years to get here. I mean, it's been, the reason home prices have been rising faster than people's incomes has been the lack of supply.
David, you're giving me a little bit of PTSD having just come off of my CMB exam because I think, and I see Bob Mimi on here, he probably would have said that you said it far better than I did when I answered the question around what have we learned from crisis and times of the past. And hopefully I don't get in trouble for sharing that question because we're going to change the questions, right, Bob? But that being said, I mean, what have we learned? And, you talk about we didn't have a correction then, now we're seeing the pendulum has gone the complete opposite direction. What are your views on what we have learned and how we move forward into 2025 and what you see as potentially, some hopeful optimism in the next year and onwards from there?
Sure. There was quite a few lessons from 2008. Clearly, the ability to repay is very important. And I think a lot of that was lost. People thought home prices will rise forever, so the ability to repay doesn't really matter because if you can't pay, you can just sell your house in 6 months and make a nice profit and it's okay. So that sobering view that don't assume home price appreciation will be there as your basis for making a risk decision, either as a home buyer or as a credit risk provider, I think that was a big takeaway. And so obviously, like the QM rules and everything else that's happened post 2008, there's been a lot of focus on it, on documentation, but really that measuring the ability to repay, I think is the key one of the key takeaways. The other key takeaway was payment shock. Obviously, the pay option products had a lot of payment shock aspects that people didn't really fully understand. So today where we are, where most mortgages being done are either fixed rates or hybrid ARMs, where you have a long fixed period with one payment change in year 5 or year 7. I think we've really addressed those two main drivers of OA from this perspective of payment shock or ability to repay, making sure those are important. But also the mindset. I think there's a lot of just absolute speculation. I'll never forget the story of the Los Angeles taxi cab driver who would drive up to Las Vegas and buy 5 houses at a time in new subdivisions that weren't yet built. And he would use the liar's loan program and lie about his income and buy 4 or 5 houses. And then when they were built, he'd flip them and then redo it. And that kind of behavior just added gasoline to the fires of excessive exuberance that drove 2008. So I think homeowners today, a lot of people, even if they weren't in the market then, they're aware of what happened. So I think those scars kind of create a healthy balance where people are more careful and thoughtful about decisions to buy homes and timing and making sure the right ground foundation's in place. It's not just a bunch of exuberance, and we're not a bunch of flippers trying to get rich quick in 6 months.
I think that dynamic is really evident too, because one of the things that feels, maybe it's the pendulum swinging to your point that these issues are actually more top of mind for mainstream media, but it seems like there's actually more news today about how unaffordable housing is. We're seeing Mark Cuban called the homeowners insurance problem the biggest problem to the American homeowner in the market from an affordability perspective. Closing costs seem top of mind, particularly inside the Beltway, but also for any consumer that has to bring 10 or 12% the value of the house to closing. You've got natural disaster risk that is somewhat and related to the HOI thing, but also not. So do you have a sense, as this pendulum swings back and forth and we think about risk, but we also think about helping new homeowners get into this market and psychologically trust that they can afford it going forward, what role do mortgage companies play? How do we think about that? And what advice do you give to our audiences, mostly, product developers, capital markets, strategic leaders, CEOs of mortgage companies? How should they be thinking about addressing this?
I think our fundamental issue we face as an industry is a math problem. It's a math problem of the upfront cost to get into the home, and it's the math problem of the monthly payment, the total payments, taxes, insurance. And in a lot of areas, you look at different components, like the insurance crisis. I mean, flood areas, wildfire risk in the Western U.S., insurance premiums have increased dramatically in many areas. And it's not just people getting into a home, it's existing homeowners. My father was a perfect example. He was a retired police officer living on retirement, and his taxes and insurance equaled his entire take-home pay. And so the increased costs of insurance are definitely an issue. And each one takes unique solutions, but I think these are areas that are rightfully getting lots of industry focus, and there are certainly effective means to mitigate. The home I'm sitting in right now is in west of Boulder, Colorado, and in 2010, the biggest fire in Colorado history, or the most destructive, went right through the property, burned everything, but our home survived because we had mitigated the property. We removed fuels off the ground, we thinned the trees, cut low-hanging branches. Neighbors who didn't do that lost their homes and lost their trees. And so there are things we can learn from. We can't eliminate fires, but we can certainly make homes more resilient. There's amazing nonprofits that are available that can do home assessments and help homeowners understand what the risks are. But I think these things all tied together. So it's back to the math problem. I think we have to take each aspect of the problem and to create individual solutions. So whether it's high cost of insurance, just the down payment. As home prices keep rising faster than people's incomes, just the down payments are a challenge. And then rising home prices, rising interest rates just makes the monthly payment a challenge. So we have to break these down into little individual pieces of the bundle and solve each one individually.
David, what conversations, either yourself or Guild or in general, do you feel like the industry is having to help push some of these changes through? Because this is not a one person can solve, right? It takes a village. We need the GSEs to partner with us on this, which obviously you have a history there. We also need our agencies to help us with these issues. So what conversations are you either involved in, or what can you share around your insights there on efforts that are either underway that we can continue to support, or other things that lenders can do? Because obviously what you're speaking to is a variety of issues that are all impacting cost.
Right. I think a lot of these solutions require innovation. If we keep doing things the same way, we shouldn't be shocked we get the same results. And a lot of innovation comes through the GSEs. If you look at most innovation that's hit our industry in the last 10, 20, 30 years, probably 99% originated through the GSEs. And then it trickles up to the jumbo market, trickles down to the government market. But really the GSEs, I think, will be solutions, or the drivers of the solutions for a lot of these issues. So in terms of like what we're trying to do to address these, a lot of it is increasing awareness. So if there's a problem you face in a local market, maybe it's the cost of homeowners insurance for condos, or flood insurance in one market, fire insurance in another market, sharing awareness more broadly within the industry and with the GSEs and with different government entities, both at state and federal level. A lot of the insurance aspects are driven by states and state insurance commissioners. So it's not just one easy solution that we could do nationally. We have to work at the state level with insurance commissioners to address issues. So, but I think a lot of this is education, awareness, getting the right people together to understand what the issues are and then look at different options. Certainly in the insurance, you can create larger insurance pools where you have more diversification and you reduce some of the math risk that can solve part of the problems. You could bifurcate traditional homeowners policy with like liability insurance versus replacement cost insurance. You can make an argument that homeowner replacement insurance risk is part of the credit risk, because the credit risk holders are banking on the fact that there's protection if the property is destroyed by fire or by wind or flood. So there's lots of pieces that I think we can all help connect the dots, but a lot of it starts with education, awareness, through the industry, and I think helping to drive the communications and those discussions is key.
So let's pivot to that question then, for kind of like what's next? What's the sort of immediate phase we're entering into? Because one of the things I've always relied on, Sasha and I talk about it a lot on this show, which is technology is pretty good at the things it's good at. And one of the things it's good at is looking at that holistic data environment and then visualizing it. Data visualization is one of the keys to technology. And so you just talked about a really complex problem. Mortgage companies are math problem solvers. And now we have technology that's actually doing a better job up front, pulling in data, visualizing that credit worthiness, ability to repay. So can you talk a little bit about how you think about that at Guild when you present that to the market, or choose to use a tool or not use a tool? What is it that technology is doing for you that you think is what everybody should be doing, or what everybody will be doing in the next few years?
I think if we look at our industry at the highest level, what we do is we collect an immense amount of data from a human being about themselves to understand their risk. We also get an immense amount of data from a property to understand the collateral that would support their risk. And really, to what you just described, the answer is, how do we use technology to evaluate all this immense data and make the ultimate decision, or the optimal decision, on how to make a credit risk approval for that borrower, for that property. And at the end of the day, it's, the data we thought years ago, oh my gosh, we went from paper statements to, we had email versions, and now we're all electronic. And so I think the digitization of that data will continue to make it easier to access, easier to sort through, easier to glean very critical insights to, more accurately define and address risks and help bring the solutions. And so I think the answer lies in the data, and our improving ability as an industry to use that data thoughtfully to make the most optimal decisions with respect to risk, credit risk for the borrower, and property risk from the various different risks that a property would face.
I'd really love to make a fax machine make a noise right now just to prove that somebody still has one. No, I'm kidding.
We need a morning radio board, Sasha, where we have
I
those like
know,
morning
you can
radio
hit
sound
the
effects.
noise to make a
A little
joke.
cheesy, but it'd be fun. Yeah, exactly. I love it.
Not triggering PSTD, that would do it.
I agree with you on that, David, though. And, I recently switched from an e-close company to a verifications platform that credit is obviously one of our mainstays. And so we talk a lot about using the right data at the right time to help you make more informed decisions. On that same note, what are you and or Guild thinking about when you consider companies that are starting to really leverage AI in this space?
I think the promise of AI in its ability to make sense out of massive amounts of data holds huge promise for our industry in terms of how it can fit our business model. A lot of it we're at the very tip, the beginning to understand what the impacts might be. But I think as we look at AI, very much it can help improve credit decisions and find other ways, especially we're trying to dimension different risks from climate change or wildfires or floods or other areas that could be having issues. So it has a lot of promise. It's definitely too soon to tell. So at this point, it's more hope and optimism than actual practice we can see. But certainly at the pace of AI's growth and improvement, it certainly could be something that could be a very relevant impact to our industry as we look forward.
We like to try to bring in some questions from the audience. I know we've had an active chat, and Paul, thanks for jumping in. And Mike had a question I think is a good question for you, David, to think. When we balance that credit worthiness and the credit risk decision based on what we saw in your, financial data with the property risk, there's kind of the question of like, well, if you have enough in the property, then you're really just looking at monthly payment at that point. I was wondering if you could talk a little bit about the way we should be measuring these risks, because we don't spend as much time talking about the property, candidly. We are now because of HOI and natural disasters. Is there anything you're seeing on the property side, whether it's AI, whether it's technology, that you would say this is actually going to get us there faster on the property as well as we, talk about home affordability and getting people credit approved faster? What are you seeing on the collateral side other than the mitigation?
I think one breakthrough that's in the process of happening today are digital appraisals. And these are not just digital photos and digital data, but a lot of appraisals where you can do 3D scans of rooms and basically stitch these together. So what that allows is a person who's not on the property themselves can have a view as if they were standing there. They can get a complete assessment of the room, the dimensions. The scans are very high quality. You can look at details and see, is that a shadow on the wall or is that a water stain from a leaky roof? So I think the digital appraisals will let credit people sitting in seats far away from the transaction have a much better understanding of the property, both exterior and interior, and help have a better credit risk decision. How many times we've seen underwriters in faraway states making key decisions on a property where a loan officer is trying to explain to them what is really happening, and it's hard to really see it through the traditional process of traditional appraisals. So I think that's a giant step to kind of create more awareness of the true condition of a property from a credit risk as well as a borrower or buyer appeal perspective. And at the same time, if we can take some of that digital data, hey, if this roof has asphalt or steel roof versus a tile roof. Which one does better in a windstorm? Which one does better in a firestorm? Which one does better in heavy rains? And start finding correlations of data. And then we can start saying, hey, if you were to change your roof from style A to style B, you would reduce this risk, or you have a much lower percentage of taking sustainable damage above $1,000 when the next event occurs. So this is like using AI again, potentially, but I think it'll give us more data, and we can find what works, what doesn't work sometimes, which might be intuitive through the data.
David, I hope you're
Sasha,
on every industry committee possible for every organization, because you have fantastic ideas. If not, I bet you there are a few people on the call that will be recruiting you after the fact. The other question I was going to ask as it relates to Paul's comment, which is kind of the flip side. Like we're sitting here saying, how do we balance the, credit worthiness when we're looking at collateral versus the person? On the people side of it, on the affordability concept, we're, seeing a significant shift in demographic. as time moves on. We continue to be more and more of a melting pot in America. And there are more demographics we need to reach, and that affordability piece is critical. And so his question, and I'm summarizing it with my own words, but basically, what are you seeing that we are doing, or what should we be doing better in that space to make sure that we can really approach a diverse market?
I think it's super important that our industry serves all home buyers. And there are home buyers today that are not well served by the industry. And I think one of the key reasons is we have a blind spot in our credit risk decision process, which is since the 1990s when credit scores rolled out, we've become too reliant on credit scores. And so the challenge is roughly half of our country doesn't have substantial credit history, and about a quarter of it is pretty close to having no credit history. And so today, the process to serve that one quarter, that one half, we do have manual underwriting. It's incredibly clunky. The documentation could be literally a few hundred pages of PDFs into a file to create non-traditional histories. And very few people actually successfully get through it, because even if you do get through the underwriting, the pricing from both the GSE risk-based pricing grid and then MI pricing grids is very punitive. And so you get approved and your interest rate might be 2% or more above current market level. I think our gap is we look in rich, deep detail at a person's history. We do not look in deep detail at the person's current position. And so I'd argue any person's ability to repay is based on their past performance, but also their present ability. And to me, present ability is measured by what is a person's true take-home pay and their actual expenses. So if you want to apply for this mortgage to buy this house, do you have enough money to pay the bill every month, as well as your other bills? I mean, it's such a straightforward question. The way we measure it today as an industry is one pixel point in time. The day you sign your note, you have a DTI threshold you have to meet to get approved, and it's based on your gross income by your credit expenses. That is not the best way to measure a person's income. No one pays bills with gross. We need to look at their net pay. And we need to look at all your bills that are non-discretionary, not just what's on your credit report. So our measurement of DTI, I would argue, is poor. And we look at it one pixel point, one point in time. The day you signed a note, your DTI was 45. Where were you a week ago or a month ago? Is that abnormally high or low? We don't know. So residual income over the last 12 months, real take-home pay versus real expenses, is a very powerful way to look at a person combined with their credit history. Those two together give us a better picture. And our industry is just starting to evolve to address that blind spot we have today. We're in the very early phases as an industry.
So that's a perfect tee up for this kind of later question of innovation, because one of the things I have wrestled with, even on this show, is what's the bridge from here to there? So we know that dynamic underwriting, right? Cash flow underwriting, which you and I are both big fans of, is the most honest way to look at how resilient a person is to make their bills and create a life for themselves and their family. And yet we're stuck in policy technology that is just dependent on documented gross income. Is residual income really the only or the very first bridge step? We just pull residual income from one agency into others and then build on it? Or is there a technology solution? Is it a combination? Do you have a sense, just prediction? I know none of us have a crystal ball, but it is called Now, Next, Later. So how do we get from here to there?
I
Next couple
think the
steps.
answer is the consumer being able to use their digital bank account data and be able to share that with lenders. It's consumer permission data. I don't think it makes any sense to have this data out publicly on public bureaus where it's out there for the whole world to see or to purchase, because the data could be very invasive of a person's privacy. But I see this scenario as individual consumers, individual home buyers permission that data to the lender they're working with. And that data flows from the lender into the AUS models of the GSEs. And also the lender can use that data, and with just basic analytics as well, certainly with AI, we can quickly look at the data and say, hey, for the last 12 months, this person has had enough take-home pay to pay all their bills and have X, $500 left over at the end of the month. Yeah, that person could do this mortgage and still live. And there's people today who pass the GSE AUS engines, and they literally have non-discretionary expenses that exceed their take-home pay. They can pass the model, And we shouldn't be shocked that person defaults in 12 months because they were living beyond their means and it wasn't sustainable. So yes, that data, consumer permissioned, um, thrown through to lenders into the GSE AUS engines, into the mortgage insurance pricing engines, that's the way of the future. It is happening now. The GSEs do have the ability to ingest the data, but it's not common on most loans. But I think that's the tip of the iceberg. We're getting there.
And there's technology solutions. So to your point, David, lenders can do it, GSEs can do it, the tech is there. So then the question is, what's the missing component? I mean, I know we've got to get consumers into a different mode of being, but they're already kind of in that mode in other places, right? And obviously younger generations kind of grew up with technology in their hands, so they're even more comfortable with it. And they're going to be more of our first-time home buyers. But like, what is that missing gap? Like, where's the piece that we've just got to like plug in?
There's definitely a bit of a barrier to consumers feeling comfortable to share their data, because when you share your data, you have to link your bank account to a third-party platform. And through that process, you're entering your passcode and other factors. And so to me, it's no different than when internet shopping hit the world, 25 years ago, and we felt really weird putting our credit card out on the internet. So I think consumer acceptance of sharing the digital data will be a bit of a barrier, but there are ways to do it where it's completely protected. And you could argue, if you're worried about your identity being stolen, mine was stolen when I did a traditional mortgage with a traditional large bank.
Right.
And they literally found out that my bank account statement was left open on someone's desk at night, and someone took a picture and stole my data. So keeping the data digitally encrypted into a very protected system arguably is perhaps maybe safer. But I think the consumer awareness is key. And I think younger people be more comfortable to share that data perhaps than older people. So I think as time goes by, but really younger people who don't have 10 years of 10 accounts on their credit history are the ones that will benefit from a deeper look at their current position when they don't have extensive past history to show an underwriter. So I think that's where we solve the problem of the underserved markets who don't have the deep credit history.
I'm really glad we landed here too, because it is one of those key things that is going to be a strategic decision for everyone listening and all of our mortgage companies in this industry, which is there a technology solution that empowers consumers, allows them to trust the process, or are you getting it from your lender because you've already committed to that lender or you've already are doing business with that lender? And those are some of the strategic decisions that you have to make in this industry. You have to decide, am I going for the consumer up funnel? Am I going mid funnel? Am I trying to deliver this technology that David just described to a consumer who's already, come to me for a loan estimate? Those are the critical cost components of saying, how do you take your business to the next level? And I get really excited because that's where we should live on Now Next Later. I think that's where this industry should be talking about. How do you get this power in the hands of consumers? It sounds like that was all set up for our sponsor today. We are sponsored on Now Next Later, believe it or not. No, we are. And FormFree sponsored this episode. And really, I think we landed there independently because this is the key question you have to answer. How do you solve for the data? How do you solve for it up funnel? And who's going to give that, to Sasha's point, who's going to give that power to the consumer in a way that they can grab it, trust it, use it, and complete the cycle that we really need to see of adoption?
To me, the logic of it is so overwhelming that it's going to happen on its own. And I think the sooner we can see this, we'll just help it get naturally. Because at the end of the day, if you're the consumer and you have this powerful data, wouldn't it be really easy just to digitally push one button and zap all your data to a car loan or mortgage loan company that you're applying for? Think about today when you apply and the barrage of questions. You go, okay, give me some bank statements, do this, fill some application. You're providing all this data piecemeal. It spends a lot of your time to do it. And if you could choose to, imagine you talk to a home buying counselor, and that's your first step in the process. Before you even apply, what if you could digitally zap your data to that counselor? That basically gives them your complete monthly budget, and not just today, but the last 12 months. Your counselor could take that data in 2 seconds and give you incredibly powerful feedback on what you could do to accumulate money for a down payment, maybe where you could maybe reduce expenses, basically get you home ready, or even tell you maybe you are home ready today from the data. So
Right.
that power to the consumer, where they can choose who gets their data, where it goes, it's the right balance of deep, rich data that can be powerful for decision, but also invade a person's privacy. Given that to the consumer to decide who and where it goes, I think that is the answer to a lot of these questions.
And what you're
I
hitting
couldn't
on
agree.
is the financial literacy piece, which is that, again, another missing component that we haven't had for a while that is starting to become more and more prevalent, whether through MBA programs, GSE programs, companies like First Home IQ, et cetera. Like there's a lot of that we're starting to see more prevalent. And I think it's critical because the consumer will feel more trust in leveraging technology if they understand the power behind it to help them not just become more financially literate, but also to make hopefully one of, if not the biggest investment towards building wealth for themselves and generations to come.
Sasha,
Absolutely.
you
We'll
made
end
one
on
of the
this.
most important,
Go ahead.
one of the most important points. Financial literacy will be key to how we serve all home buyers of the future, but especially the new home buyers, because if you can improve financial literacy with data, that's the actual real data, you help them understand a better picture of themselves, make better life decisions, and that literacy will be a major part of how we solve, helping serve the future home buyers. It'll be absolutely core critical.
Couldn't agree more. And that's where technology comes in. We can now do that in a new and different way. We're not offline. We're not on paper. We're not reproducing things multiple times. We've actually come to the cross section, I hope, of where technology, lending, and consumer expectation are meeting. And that's when you get adoption. So, on that hopeful note, thank you so much for joining us, David. This has been fantastic. Now, next, later. We really appreciate it.
Thank you. It's been wonderful to spend the morning with you. Thank you.
Right on. Thanks, Paul. Thank you, FormFree. And we'll be back next week. Now, next, later.